Yeah. So I'm here with Phil Daian. He's a PhD student at Cornell Tech, working on research around security, blockchains, and specifically a lot of other stuff as well. And he's definitely an expert in many of the things that we're going to be talking about today. Phil's presented in a variety of conferences and a well-known researcher within the Ethereum ecosystem. So I think maybe what we want to talk about today is a topic related to blockchains, specifically around hacking decentralized exchanges. Or not hacking decentralized exchanges, but being able to...
Decentralized exchange security, I guess.
Right.
Yeah.
Being able to cheat in some ways, or to take advantage of it in a non-obvious way for many people. Mm-hmm. And specifically maybe about this idea of something called front running. So maybe it would be great if you could give an introduction of what a decentralized exchange even is.
Yeah, so a decentralized exchange, or a non-custodial exchange, as some people like to call them, basically involves having a blockchain program, or smart contract, as they're sometimes called, operate the settlement part of an exchange. So what does that mean? If you and me want to trade two tokens for each other, normally in a regular exchange, we would both send our tokens to the exchange as deposits, do whatever trades between us that we wanted to, and then withdraw our money at the end. In blockchains, the problem is a lot of these exchanges are not very reputable or trustworthy, and managing cryptocurrency is also very hard. So once you send your exchange those coins, you're trusting the exchange to keep them safe and not lose the key and stay online, and all these other things. So that's been historically kind of a bad idea in the cryptocurrency world, because these exchanges have often been hacked, have lost like tens of millions of dollars of user money, sometimes have gone bankrupt without even being hacked because they're doing sort of shady stuff behind the scenes. So Mt. Gox is a good example of this. Bitfinex is another big exchange that at some point was hacked and lost like 10% of all their money, and things like that. So users, for a good reason, don't really trust these exchanges. So one solution is to use the blockchain itself, or a smart contract on the blockchain, to run the exchange. Then when we want to trade tokens, instead of sending them to this exchange, we both sort of agree to do a trade somehow, and we bring that sort of receipt of us agreeing to do a trade to a smart contract or a blockchain. And the blockchain will just do the swap, basically atomically, instantly, and give your tokens to me and my tokens to you, in such a way that neither of us can sort of cheat the other person. So in that way, you always have control of your tokens, and once the exchange is performed, you sort of directly get control of the new tokens, and there's, in theory at least, less of a risk of losing money.
So is the idea of a decentralized exchange basically, instead of having this software being run by a company, it's now being run on this blockchain, and nobody can change it. It's technically something that runs without anyone's control.
Yeah, exactly. And also, if you have a non-custodial exchange, the users keep control of their funds at all times. So the exchange contract only executes a trade, but when it executes a trade, it does what we call an atomic, or an all-or-nothing trade. So either everything in the trade works or nothing works. And so if you keep holding onto your money, and then the only trades you do are atomic trades, you always have control of your whole funds at any point in time, and you don't have to give it to an exchange or anything like that.
You recently just published this paper on front running, but you've been working on this for a while. Could you explain what front running is, and why is something like this happening, or why is it important? Does it happen in existing exchanges?
Yeah, sure. So front running is a very old term. It comes from sort of the 20s, back when people were thinking about regular stock markets that often work with like a paper kind of trail order book before even digital trading sort of existed. And what it would refer to was, so people would often place trades through these other people called brokers, stockbrokers, that sort of manage their actual trading for them. And these brokers are the ones who would talk to the exchange and actually put the order on the books of the exchange. So what could happen is, if you knew a particular order was coming through some broker, that let's say someone wanted to buy 1 million shares of, I don't know what stock was popular in the 1920s, like Standard Oil or something like that. So someone's going to buy 1 million shares of Standard Oil, and you know that that's going to make the price of Standard Oil go up because there's just like more demand and they're buying up all the available supply. So what you do is you run in front of the broker who's like walking over to the desk to put the order in, and you buy Standard Oil yourself really quickly before that person can buy their 1 million shares. Then when they buy the 1 million shares, you know it's going to move the price up, and then you sell whatever you just bought at that higher price. So you basically profit because you knew in advance that they were going to move the price before sort of anyone else did. And you got your order in front of them before they could move the price. So someone might sort of cut the line in this process, which is what this front running refers to. Also, another thing that's kind of important in front running is this sort of trust that a user puts in the broker. So when a user is making a trade through a broker, they assume that the broker is not going to insert their own trades sort of in front of this trader or otherwise try to profit from them, because they're paying the broker to do a service and they trust that the broker will do that service honestly. So in some ways people see at least classic old-fashioned front running, the most narrow definition of front running, as this violation of trust between the user and the broker, because they'll make more money that way.
Got it.
So that's what front running used to be, and it is a big problem in electronic trading also. So if you can notice that someone is about to put in a big order and like just jump in front of them and cut the line, you can pretty much always profit off of what that order is going to do to the market.
Would this be considered almost insider trading?
Yeah. So broker front running, the specific kind I mentioned where a user trusts a broker, can be seen as a form of insider trading in a way, yeah. Or if the exchange is doing the front running or something like that, there are a lot of different possibilities.
How does this relate to, for instance, decentralized exchanges, and like what does your paper go into? Because it's a in-depth paper, and your presentation on it, it was like really analytical. So
so the interesting thing is, in a decentralized exchange, because you're doing this on a blockchain, the miners, or the ones who are making the blocks on the blockchain and controlling the order of transactions, get to decide exactly what executes and in what order. So in that way, the miners have full control to see exactly what trade you're going to make and put their own trade in there if they want to. So essentially, the miner is able to front run your order in many of these decentralized exchange designs. And the reason that happens is just because of how these exchanges are designed, because there's no sort of concept of order in them. There's no notion of like who gets to fairly execute an order and who doesn't. It's just like anyone can take any order for many of these exchanges, which lets the miners come in and sort of play the game to profit off of users.
Right. And maybe this gets a little bit more technical, but in the idea of a decentralized exchange, I think you mentioned that gas prices or the fees for each transaction affects who gets ordered first. So like, what is the maybe idea behind that, or how does that work?
Right. So in today's world, even though these miners who make the blocks have the full power to front run people, they're actually not doing that. So the miners are not actively front running people right now. Even though they probably should, and it's profitable for them to do it, for whatever reason they've chosen not to do it. So what happens instead then is that because many of these networks are public and everyone can see the transactions before they're actually put in the blockchain, any user is also able to front run people. So the way that works is you watch the network for other people making transactions, and if you see a transaction that's like nice to front run that you want to put yourself in front of, you basically just offer to pay the miner of the next block more than that transaction paid, right? So I see you want to buy 1 million Standard Oil tokens on Ethereum on a decentralized exchange. and I see your order come in, and I know it's going to move the price of the Standard Oil token up. Let's say you're paying $5 to have your transaction processed. Then really quickly I tell everyone on the Ethereum network, no, actually I'll pay $10 to buy some Standard Oil. And then because I'm paying more, they'll process my transaction first, and I'll be able to sort of front run you. Again, this is one of the more controversial definitions of front running, because technically all of this information was at least ostensibly, like, it seems public, right? But it gets more subtle, because on this peer-to-peer network, there's some people that have sort of better vantage points and a better ability to see orders more quickly and reply to orders more quickly. And at the end of the day, the user sort of doesn't expect all these people to be watching and waiting for their order to come in and to try to front run them.
So why do you think the miners are not doing the front running? Because I guess the difference is, as a normal person that's watching the network, they have to pay an extra fee to do the front running, whereas miners technically don't, right?
Exactly.
So yeah, they get it for free, and it seems like the amount that they can make seems to be very big. So, like, do you think it's just that do you think they're not doing it because it's completely transparent?
For one, not that many people use DEXs. For another thing, it's kind of requires some engineering effort for miners to do this, and maybe they just haven't paid the people to implement it yet and gotten that engineering. But neither of those are really compelling reasons long term. In theory, they should still be doing this. And another possible explanation is, like you said, they care about their reputation or something like that. Maybe they're running a pool and they want to get other people to join their pool. They don't want to scare them away. So they want to seem fair, and they choose not to do this kind of thing. But yeah, it's an open question why they're not blatantly sort of just taking all this money off the table.
Got it, okay. What would you say is a reason why people should use decentralized exchanges versus something else? And maybe what is some differences?
Yeah, so one could be that they're concerned about being hacked, and they don't want to lose money. They don't trust the exchange to hold their money. Another could be that they don't trust the exchange to be honest in other ways. So maybe the exchange is running a fractional reserve where users have 1 million Bitcoins deposited, but really the exchange only keeps 10,000 Bitcoins for processing withdrawals and does something else with the rest of the money. There's many exchanges don't publish sort of audits that say how much money they have at what time. So there's no way to know whether the exchange is fairly holding your money or not. So that could be one reason. Another reason is that centralized exchanges can also front run you. So a regular old exchange, when you go to trade on it, can sort of manipulate the way your order is processed and insert their own order in front of yours. So if you don't trust the person who's running that centralized exchange, then it's just as bad as a decentralized exchange in terms of front running. They'll still front run you anyway, potentially. And for most classic exchanges, like the New York Stock Exchange or something like that, it's very illegal for them to front run you or offer too much of a priority arrangement to certain people. So there's sort of a regulatory fallback there where you trust that at least the New York Stock Exchange is not breaking the law. You have some guarantee of that. But for the cryptocurrency exchanges, many of them are headquartered in places like Singapore or Malta or various islands around the world and things like that, where they're not actually enforcing that the exchanges don't front run you. So it's totally possible they might. A good example of this is usually when you're running an exchange, you're not supposed to be looking at the orders that are coming in and also trading on the exchange yourself at the same time, because it's considered that you have some private information about orders coming in. You shouldn't also be trading because potentially that's insider trading off private information.
Right.
Whereas in cryptocurrency exchanges, there have been several times when people who are operating large exchanges will go on TeamSpeak or something like that and talk about how they're both looking at the order book and trading. So even though this would be illegal in a normal exchange, in cryptocurrency exchanges, people do this out in the open. So it makes you wonder what other ways are they manipulating you? So maybe people could feel that, yes, the decentralized exchanges are bad for front running, but for cryptocurrency, there's just nowhere better to trade that that doesn't front run you.
Right.
Maybe unless you trust a regulated exchange in the US like Coinbase or Gemini.
Then do you think this idea of front running, especially in decentralized exchanges, is a solvable problem, or do you think this is a fundamental problem based on the design of blockchains?
I think it's a fundamental problem for all sort of continuous limit markets that run in like a permissionless setting, so like a peer-to-peer kind of setting. Mm-hmm. There's always going to be, because like to get your order processed, you have to send it to someone who has to send it to someone else, who has to send it to someone else, and then it gets processed by a bunch of miners. So because it's decentralized, there's a lot of people involved in this chain. Mm-hmm. And those people have kind of power over your order. They might be able to delay your order, or put their own in, or read your order, or do certain things like that, try to censor your order. So fundamentally, you always have to give that power to somewhere, to someone, rather. And so in that way, it's fundamental. There are things you can do to restrict certain types of front running. So one example is a very simple one. I encrypt all my orders, and then I just publish the key like later, after they're included in a block already. And they're processed in the order they're included. So at the time the miner puts it in, nobody knows what's in my order. Generally, this style of scheme is called a commit reveal, because you're basically committing to your order but not showing anyone your order, and then later you're revealing it, and it gets processed in the order you committed it. The problem is this slows down trading, obviously, because you need these periods of like committing and revealing.
Right.
And so there are mitigations you can do that take away certain types of front running, but they come with other trade-offs. And a lot of traders don't like the trade-offs. A lot of traders want things to happen as quickly as technically possible. And if you want things to happen as quickly as possible, then that means there's always going to be some time-based manipulation that you can do.
Got it.
Yeah.
So, cool. Let me just pause this 1 second.
Yeah, we